Silver didn't climb. It detonated. In late January 2026, markets crossed a line they weren't supposed to cross. Silver blew past $116 an ounce. Gold surged beyond 5,100. And here's the paradox. This didn't happen during economic growth or optimism. It happened during stress, during fear, during a flight. What makes this different isn't just the price, it's the speed. Silver gained more than 12% in a single session, over $12 in one day. Moves that used to take months now happen between one close and the next open. If you're watching this thinking it's just another bull market, notice the detail that breaks that assumption. There is no resistance, no ceiling, no pause. This matters to you because markets like this don't reward patience. They punish delay. When price moves faster than expectations, wealth doesn't rotate gradually. It transfers violently. And here's the part nobody is saying out loud. This doesn't look like demand chasing growth. It looks like money running from something. So the real question isn't why silver is rising. It's what the market is trying to escape. What you're seeing didn't start in New York or London. It started elsewhere. While Western markets quoted silver around $112, another price was forming quietly in the East. On the Shanghai Futures Exchange, silver was being bid as high as $130 an ounce. At times, $15 higher than the Western price. Same metal, same moment. Two radically different valuations. That gap matters. It tells you where real demand is setting the terms. Shanghai isn't trading paper exposure. It's pulling physical supply. And that pull is strong enough that Chinese regulators stepped in, tightening trading limits and restricting new positions. That's not normal behavior in a calm market. Now notice the pattern. When exchanges impose limits, it's usually to cool speculation. But here, those controls aren't slowing price. They're confirming stress. Similar measures failed before when physical shortages were real, not theoretical. This is where the story reframes. The West still prices silver through derivatives. The East is pricing it through urgency. And when those two systems collide, one has to adjust. Here's the question that resets everything. If the highest bid for silver is coming from outside the dollar system, who actually controls the price? The pressure from that gap is already breaking institutions that used to control this market. In the West, banks weren't positioned for this. Some were betting the move wouldn't happen at all. Evidence of stress is no longer subtle. TD Bank temporarily halted sales of silver products not because demand vanished, but because inventory did. A major bank stepping away from retail sales is a warning flare, not a footnote. Then there's the personnel signal. Reports show the head of precious metals trading at Goldman Sachs exiting right as silver goes vertical. The reason isn't officially stated, but timing matters. When senior traders leave during violent repricing, it usually means positions failed, not that forecasts succeeded. Here's why that detail changes everything. These institutions weren't just observers. They were active participants on the short side, using leverage and paper supply to manage volatility. As price explodes, those positions turn toxic. Covering them requires buying into a rising market with limited liquidity. This is where the story flips. When traditional sellers retreat, momentum doesn't slow. It accelerates. The brakes are gone. And in a small market like silver, even modest capital flows can overwhelm supply. So ask yourself this. If the biggest players are stepping back, who's left to stop the move? The answer lies beneath global liquidity, and it starts in Japan. For decades, the yen carry trade quietly powered markets. Institutions borrowed yen at near zero cost and poured that money into higher-yielding assets around the world. Stocks, bonds, everything. It worked because rates stayed pinned. That assumption just broke. The Bank of Japan is losing control. Yields across Japanese government bonds are surging. 3-month yields flipped from negative to 0.77%. 2-year yields jumped above 1%. The 10-year pushed past 2.3%. And the 30-year, nearly 4%. That's not a move. That's a regime change. Now watch how fast this escalates. As borrowing costs rise, the carry trade unwinds. Positions must be closed, assets sold, liquidity pulled back. But the capital exiting doesn't sit in cash. It runs from currency risk. This is where the pattern locks in. As fiat systems destabilize, hard assets absorb the shock. The timing isn't coincidence. The yen losing its anchor and silver entering a melt-up are connected through global leverage snapping. This is where the story flips from a metals rally to a monetary one. The revaluation shows up clearly in one one ratio that traders watch when systems are under stress. The gold to silver ratio has collapsed to 44 to 1, not drifted, crashed. Silver isn't just rising with gold, it's outperforming it. Gold breaking 5,000 is dramatic. Silver moving from the 30s to over 116 in months is something else entirely. Here's the detail that reframes valuation. Historically, this ratio compresses during monetary stress. In 1980, it fell as low as 14 to 1. Even in 2011, it reached the low 30s. At today's levels, silver is still not extreme by historical standards. It's catching up. Now notice what this enables. As the ratio compresses, holders of gold start swapping into silver to capture the outperform. That rotation adds fuel without requiring new capital. At the same time, silver's market capitalization has expanded to roughly $6.3 trillion, surpassing major corporations and cementing its role as a Tier 1 asset. This isn't speculation chasing upside. It's valuation correcting a long imbalance. And once that correction starts, it rarely stops halfway. So the question becomes unavoidable. If silver is still cheap relative to gold, what happens when the ratio keeps moving? Now the stress concentrates where paper promises meet physical reality. On the COMEX, registered silver, metal available for immediate delivery, has fallen to roughly 114 million ounces. At the same time, open interest in the March contract represents potential claims on more than 520 million ounces. That's nearly 5 times the available supply. This is where the system becomes fragile. In January 2026 alone, over 9,000 contracts stood for delivery. That's about 46 million ounces leaving the exchange in a single month. Compare that to January 2024, when delivery demand was a fraction of that. The change isn't gradual, it's exponential. Now watch how fast this escalates. Eligible inventory is falling too, draining the buffer that usually absorbs stress. If even a portion of March contract holders follow January's behavior, the exchange faces an impossible choice. This is where the story flips. Futures markets survive on rollover behavior. They fail when participants want the asset, not the cash. And once delivery becomes the objective, leverage stops working. At this point, the impact stops being theoretical and starts landing on people. Not traders, not banks. You. At the retail level, the system is seizing in a way that feels backward. As prices soar past $110, coin shops and bullion dealers aren't celebrating. They're choking. Here's what's happening on the ground. The public is rushing to sell. Dealers are flooded with metal. But instead of paying spot, many are imposing limits. Some cap purchases at 100 ounces per customer. Others stop buying entirely. Not because silver isn't valuable, but because cash is the constraint. Their capital can't keep up with the speed of the move. This is the detail that changes how you see the price. A quoted spot price is meaningless if there's no bid behind it. And when wholesalers and refiners slow payments or stop buying, the entire chain locks up. So while headlines show silver at record highs, regular sellers are discovering something uncomfortable. Liquidity isn't guaranteed. Access isn't guaranteed. And when the two-way market breaks, confidence breaks with it. If this feels familiar, say so in the comments. Because this is how stress shows up before it becomes obvious. Zoom out, because this isn't a failure of one market. It's a failure of plumbing. The silver supply chain was built for slow, predictable flows. Scrap moves to refiners, refiners process, wholesalers distribute, dealers make markets. That entire system assumes stable prices and manageable volume. Neither exists now. Refiners are backlogged for weeks. Payments that used to clear immediately now stretch 15 to 19 days, sometimes arriving in pieces. Wholesalers quietly say they're done buying for now. Dealers ship metal and wait, exposed, carrying unsecured risk. This is not panic, it's gridlock. Here's the unsettling insight. Liquidity isn't disappearing because no one wants silver. It's disappearing because the machinery that turns metal into money can't operate at this speed. The faster price rises, the more the system jams. This is why the market feels broken. The paper price screams abundance. The physical market experiences paralysis, and systems under that kind of strain don't self-correct smoothly. They either slow violently or snap. This is the point where the story resolves into one sentence. Price isn't telling you what silver is worth. It's telling you what money isn't. When silver moves $12 in a day, when exchanges ration delivery, when dealers can't make two-way markets, when refiners stall and banks step aside, that's not a commodity cycle. That's a monetary signal. The system is repricing trust in real time. Here's the part most people miss. This isn't silver going up forever. It's fiat being tested all at once. Debt loads force printing. Printing forces flight, and flight concentrates into the few assets that don't rely on promises. Silver is just one of the first places the pressure shows. Reframe the entire move this way. The market isn't asking how high silver can go. It's asking how long paper systems can pretend nothing has changed. And once that question takes hold, the next chapter doesn't start on a chart. It starts when availability, not price, becomes the headline. If you want to stay ahead of where that pressure goes next, follow and subscribe. This story is still unfolding.